All right, welcome back from spring break. I hope that you all feel a little bit rested. I feel somewhat rested, not entirely, but enough. And hopefully you had a chance to do something just to enjoy your own time. It's important to make sure you set aside time for yourself in the day because it's hard to do this stuff without you being fully present. So make sure that you are getting enough of what you need for yourself. I find that that's a really important thing in life. So, welcome back. I want to just say, hey, you're all doing pretty well so far. Let's keep our foot on the gas pedal. Um, it's already March 17th, if you could believe that. Already more than halfway through March. We're gonna roll into April soon, and I tell you what, once we get into April, it goes by so fast. It really does. The time starts to really fly. And so let's make sure that we keep our foot on the gas pedal and just keep on going on, and let's not slow down. Now's not the time to slow down. Now's the time to speed up. So so welcome back. Appreciate y'all being here. So let's take a look at where we are and where we're heading. Here in the classroom, we are already all the way in week 9. Today, we're going to be talking about receivables and how we account for them. And I'm going to tell you some really fun stories about things that have happened to me. And I know I briefly mentioned some of this in class when we met, whenever that was, 2 weeks ago. Uh, and it's the receivables are a really interesting topic. So I'm looking forward to talking about that with you today. Next week, when we meet in person on the 24th, we're going to meet in person on the 24th next week. We're going to talk about property, plant, and equipment. Those are your fixed assets. And then we'll meet again in person on the 31st as well. And we'll talk about current liabilities and payroll. So, my HR people, you'll like that conversation. And that will bring us into April. And then April 7th, we'll talk about accounting for partnerships. That'll be on Zoom. Then on April the 14th, we'll talk about accounting for corporations. That'll be in person. And then April the 21st, we'll talk about long-term liabilities. That will be on Zoom. And then April 28th, we'll talk about the statement of cash flows, and that'll be in person. And that'll bring us to the end of the course. So it goes by really, really fast from this point forward. So definitely plan on, moving at a little bit of a faster pace from this point until the end of the semester, because that's kind of the flow of the course and of the semester. So that's where we are. That's where we're heading. So let's jump into this conversation on accounting for receivables. Really interesting conversation. I'm going to give you some insight into some things that have happened to me in my business and from a real life perspective, some things that I've encountered in my business. And Chef, I don't know if you've ever had to encounter something like this, but I got to tell you, it's always interesting when a customer doesn't pay. So we're gonna talk about that, and I don't know if any of you, the rest of you who have your businesses, I know some of you do, if you've ever run into that situation where, hey, the customer never paid, what do you do in that situation, right? So that's going to be a big part of what we'll talk about today when we talk about receivables and how we account for those receivables. So the first thing I want to ask you is, what is a receivable? What does that mean? What's the word receivable mean? What's going on with the receivable? What does that mean? What do you think? Star. Star, what's a receivable? You might be on mute. For some reason, I can't hear you. Who wants to go? What's a receivable? Okay, go for it. What do you think?
Um, Accounts receivable is like it refers to like outstanding balance of money owed
Money owed to who?
to the business or the customer.
Yes. Yes. Absolutely. That's an account receivable. Yep. What other types of receivables do you think that we have besides the account receivable? Anything else?
As soon as I seen her, I said, "God, sorry."
Oh,
Um,
no, you're
uh,
good.
oh,
Dario, what do you think? What other kind of receivables we got?
Goods and services.
Goods and service could be. Could be.
Uh,
credit as well.
Credit. Yeah, I was about to say that.
Oh, I like that. Yeah, Dario, that's a good one. Um, Sometimes the business will convert a customer's account receivable into a note receivable,
Oh,
right? So sometimes if a customer don't pay, they gonna pay. We're gonna take their account and convert it to a note receivable, and we're gonna attach some interest. So note receivable, it's kind of like the credit collection, right? Yeah, those are great examples. So accounts receivable, notes receivable. We also have interest receivable when the company issues a note receivable. There's also interest related to that the company receives. Um, those are the three most common ones. There's a couple of other smaller ones, but those are most common. So let's talk about those. Let's talk about those receivables for a second. So receivables is an amount of money that's due by your customer to the business. That is a receivable. And there's two very common receivables in business that we have, accounts receivable and notes receivable. We also have other receivables like interest receivable, rent receivable, tax refund receivable, and a receivable from employees where the company may have given a loan to an employee. So accounts receivable, these are the most common, and these are amounts due to the business from the customers based off of the sales that have not yet been collected. We call those credit sales. So any amount that a customer still owes the business reflects the balance of that account receivable. This graph that you see here represents the dollar amounts of receivables and their respective percentages of total assets. We can see that Microsoft sitting at $48.688 million in accounts receivable, pretty high percentage, represents 11.8% of their total assets. So when you put it in a percentage, it's really not that big. I mean, it's a big number. Don't get me wrong. 48.6 mils, no joke. There's a whole lot of money, but it only represents 11.8% of their total assets. The rest of their assets are cash, um, property, plant, and equipment, inventory, any other type of asset. And just a small percentage, 11.8% of their total assets is represented by accounts receivable. So interesting. I always find it interesting to look at the account receivables respective to the total assets. It's a good indication about the company's types of sales. Some companies they sell a lot through cash, cash paying customers over the counter, and then a portion could be accounts receivable. And it's always telling of the type of business that it is, depending on whether they have a higher or lower amount of accounts receivable balances. So that's why I always find that to be a little bit interesting. So let's take a look at a transaction related to an account receivable sale. So here we have an example where our company made a sale to a customer on account receivable. These are two different customers, just so you know. So we made a sale to one of our customers, Comp USA, computer store, on July 1. We made a sale to Comp USA for $950. So to record that transaction, we debit the account receivable for that customer and we credit sales, 950. Also on that same day, the company received a different customer's account receivable. So RDA Electronics, they're paying us from their account receivable from a sale that we made earlier on to that customer. So we're going to debit cash and credit that customer's account receivable when the customer's paying. So in this case, 720. Now, if we go through the accounting process, the next thing after we record the transaction is we need to post those transactions to the general ledger accounts. Now, as you recall from our discussion, hopefully, recall our discussion 2 weeks ago when we were talking about these subsidiary accounts, and I think that conversation was around, I want to say it was accounting information systems. This was all the way back 2 weeks ago. We're talking about those general ledgers. And within those general ledgers, we have what we call the subsidiary ledger accounts. The subsidiary ledger accounts, these are representative of things like cash, accounts receivable, inventory, property, plant, equipment, all that stuff, right? All the individual accounts represent subsidiary accounts to the general ledger. And so here we can see the posting of those two transactions and the effects on the general ledger. So let's take a look at the general ledger for accounts receivable. We see accounts receivable went up on July 1 by 950 from the sale that we made to the customer on account. And it went down by 720 from the other customer that was paying us for their account receivable. If I quote unquote zoom in on the individual customers within accounts receivable, the subsidiary accounts, I can see their respective accounts and their respective balances. When I add up all of my customers and their balances, I get my total accounts receivable amount. And that's what this slide is showing us. So those are accounts receivable. Pretty easy, pretty straightforward stuff. Now, sometimes in business, and this happens a lot, especially even more so now, I think, than before, we make a lot of sales through credit cards and mobile payment. Yeah. Everyone is becoming more connected these days through mobile applications for payments like Google Pay, Apple Pay, PayPal, Venmo, Cash App, Zelle. I'm sure there's a couple of other ones that I'm missing. There's a lot of different payment applications these days. And in business, it's really important to be able to accept payment in all different kinds of ways other than just cash, because it broadens the possibility of getting new customers, right? So these different levels of payment allow for a broader customer base. The customer doesn't have to decide, or the company doesn't have to decide who gets, credit for like an account receivable and how much it is. These methods also avoid risk of non-payment, right? Because the credit card companies and the mobile application payment companies, they guarantee payment. So what that means is that the transaction will not process if the customer doesn't have the funds. So there's a guarantee of the payment, right? Which in business is really important. You got to get paid. So it avoids that risk. The receipt of getting the cash is a lot quicker. These applications, Apple Pay, Google Pay, PayPal, Venmo, Cash App, we can link all of this stuff to our bank account And we can receive the cash in that account a lot faster. The instead of closing the batch out, like I was telling you about when we talked about accounting information systems. Remember we talked about, oh, why does it say processing, all that? It's because they didn't close the batch. With these applications, the batch closes immediately. So that makes business cash flow a lot easier. Yeah. And of course, it provides customers a lot more options to pay. So it's always good to accept these methods of payment. Now, the drawback with that, accepting those methods of payment, is that it costs the business a percentage of the sale based off of that form of payment. Okay, I think I touched on this with y'all, and forgive me if I didn't, but I'm gonna tell you a real quick thing. Have you ever been to let's say a restaurant or to I don't know, store where they charge you an additional, 3%, 4%, whatever, if you use your card? This is becoming a little bit more common, unfortunately, and it really pisses me off. But it's something that does happen. It drives me freaking nuts when businesses do that to their customers. That is insane to me. And this is the reason why. On the total amount of sales, it doesn't matter if it's $100 or $105 because you charged your customer 5%. The sale is still the same, $100 or $105. The business has to pay a transaction fee based off of the total sale amount. Okay. So that transaction fee is known as a credit card expense. It's a fee charged by the processing company. Okay. So here's how we need, as accountants, need to make this transaction. So here we have an example. July 15, our company made a $100 sale to a customer. Customer paid using their credit card. The credit card, our processing company charges a 4% transaction fee. So we got to figure out what's the fee. Well, it's $100 is the sale amount times the 4%. It's $4. That means that we're only going to receive $96. The other $4 is paid to the transaction company. Okay. So we debit cash 96. That's what we're actually receiving. We debit credit card expense $4 and we credit sales 100. Again, this part of American business drives me insane. Visa and MasterCard are some of the two richest companies on the planet. And the only reason why they got that way is because they charge a fee to use the card. That's it. It's not like they sell anything. They don't sell product. They sell a service. And they got stupid rich by doing it. Right? So that's why personally I don't like it, but it is what it is. And we have to still make these transactions. So let's switch gears a little bit. I'm going to talk to you about some stuff that happened to me in business that I was never too happy about. I had to write off some of my customers' accounts receivable. Now, why? You might ask, would I have to write off an account receivable? It's because they didn't pay. Now, it works like this. Here's the thing. Unfortunately, not all your customers are going to pay you. We expect them to pay because you provided the good of the service. We expect them to pay for that. That's business. But sometimes they don't pay. All right. I'll only tell you a quick story. I had this customer in my business. This was a long time ago. This was probably back in 2010. All right. Back in 2010, I had this customer who purchased about 500 bucks. I think it was more than that. It's about $1,500. Yeah. It's about $1,500 worth of inventory customer purchased from me. Okay. So 1,500 bucks. So I debit my accounts receivable for the customer, 1,500 bucks. And I credit sales, 1,500 bucks. So, and I told the credit terms were net 30. So net 30 means the customer has to pay me within 30 days of the sale. So 30 days goes by, nothing. Okay. So Dr. B getting a little upset here. All right, so I send a notice. Past due, pay now. Another 30 days goes by. Nothing. All right, now Dr. B getting real upset. Been 60 days since we made that sale. Customer ain't paid. What am I to do? So another notice. Past due, seriously past due. Pay now. Another 30 days goes by. So now we're talking 90 days since I made this sale. Customer hasn't paid. Now I'm pissed. I'm super, super pissed. So multiple phone calls, multiple emails, multiple messages, um, multiple mailings, certified mail, nothing. Radio silence, right? So another 30 days goes by. Now we're 120 days past due. This guy ain't gonna pay, right? So half a year gonna go by, no payment. So I need to write off the bad debt. We call this a bad debt because we expect the customer not going to pay. So this customer didn't pay. And yes, I did try to track the customer down with a baseball bat, and I could not find the customer. Okay. So this person's in the wind. So I figure, okay, I'm not going to be able to collect. I can't collect the usual way. I can't collect the other way. I can't collect. So I go back to my QuickBooks. And I go, okay, this customer ain't going to pay me. So what am I to do? I need to write off this customer's account receivable as a bad debt. So some customers they don't pay. We have to write them off as a bad debt. So there's two methods to be able to do this. One's called the direct write-off method, and this is the easiest method, honestly. And the other is called the allowance for doubtful accounts method. I'm going to show you how they both work. With the direct write-off method, it's real simple. I write off their account directly. That's why I call it a direct write-off method. The other method, the allowance for doubtful accounts method, this one's an estimate that a certain percentage of our customers is not going to pay us. That's what I call an allowance to have doubtful accounts. So I'm going to walk you through both of these with an example. So here we have a customer that didn't pay us. Multiple periods went by, multiple months went by. We're approaching year's end. Customer ain't paying. We getting upset, so we got to write it off. We're going to use the direct write-off method here. So our company determined January 23, customer's not going to be able to pay us 520 bucks. So I debit bad debt expense, which is an expense account that reduces your total net income. That's why I call it a write-off. Reduces net income. So debit bad debt expense, 520, and I'm going to credit that customer's account to write off that specific customer's account as being uncollectible. And of course, I make a note to the transaction saying, hey, why am I doing this? Just in case I get audited or if I need to look back at it. So, but this is a transaction you make. It's really easy. Debit bad debt expense, credit the customer's account receivable for that amount that they're not paying. Reduces your total net income. That's why I would call it a write-off. So that's a direct write-off method. Now, once in a great while, you might have a situation where the customer comes out of freaking nowhere. Okay, that's happened to me. That's happened to me. I had a customer, thought this guy wasn't going to pay, out in the wind, magically shows up like 9 months later. Says, "Oh, I think I owe you money." "You think you owe me money? I've been looking for you for 9 months." "Yeah, you owe me money." Right? So it happens. So here we have an example where that happened. I got a customer arose from the dead and decided, "Oh, I need to pay." Right? Comes out of nowhere. Okay, no problem. I can reverse the bad debt write-off. So to do that, I debit the account receivable for the customer, credit bad debt expense to reverse the write-off by the same amount, 520, and then debit cash and credit the account receivable, 520, to record the receipt of the payment. Right? There's a good chance I wouldn't have that person as my customer again after something like that, just so you know. It's all right for you to say, "Hey, I don't want you as a customer no more because you don't pay me." That's just my 2 cents on it. I've been around the block a few times. I think I know what I'm talking about. All right, so using the bad debt direct write-off method, it's really easy. It's super, super easy. The expense recognition requires the expense recorded in the same period in which the sale was made. So if I make the sale in 2026 and the customer doesn't pay me in 2026, by the end of 2026, I need to record that bad debt expense. So at the end of the year, I'll make an adjusting entry. I'll debit bad debt expense and credit the customer's account receivable. But you need to make sure that that happens in the same accounting period, same year, as the same year that the sale was made. That keeps it consistent. The second requirement for this is the materiality constraint permits the use of direct write-off method. It's really simple to do. It adheres to generally accepted accounting principles. So again, I prefer this method. It's really, really easy and it's very, very direct. So that is the direct write-off method. Now, I want to talk to you about the other method. It's called the allowance for doubtful accounts method. They recently changed the name to allowance method. It's the same thing. Allowance for doubtful accounts method. I'm going to walk you through it. So, in some businesses, we estimate that a certain percentage of customers are not going to pay us back. Okay. You'll get a hang of this over time. After your first year in business, or 2 years in business, or 3 years in business, you'll find that a certain percentage of customers are not paying their bills. Okay. Uh, that's part of doing business, right? So we need to be able to estimate that. And Chef, I hope this never happens to you, that you never have to go through this process. But if you have to, this is one way of doing it. This is called the allowance for doubtful accounts method. So at the end of each accounting period, we look at the average percentage of customers that didn't pay us, and we're going to use that as our percentage of customers that's not going to pay every single year going forward. It gives us a good ballpark, a good estimate of the customers that won't pay us going forward. That's what this allowance method does for us. So this has a couple of advantages to it. One is that we record the estimated bad debt expense in the period of which it relates to the sale. So each year I estimate, hey, 3% of our customers ain't going to pay us. It reports the accounts receivable on the balance sheet, the estimated amount of cash to be collected. So the allowance for doubtful accounts, the account itself holds a credit balance. It's an asset account. It's what we call a contra account to accounts receivable. Okay, so it effectively reduces the total account receivable by that estimate, but without having to actually touch the individual accounts. That's what that means. Three, the write-offs do not affect the net receivables or income, which is because it holds a credit balance. It's an asset account, therefore is a contra account to your account receivable. So that's a benefit, right? So that way you don't have to be messing around with the individual customers' accounts. One of the disadvantages is that we got to estimate, and that's estimating is sometimes hard to do. It's not an exact science. So let's work through an example together. I like this example, by the way. This one's nice. So our company has a total credit sales for the year, first year of operations of 300,000. At the end of that first year, we had about $20,000 that were uncollected, meaning that my total accounts receivable balance at the end of the year was 20,000. Based on on our experience, we estimate that about $1,500 of our total accounts receivable will be uncollectible. Okay? It's just based off of historical reference. Some businesses they'll use an industry average. And a lot of this you can just do a simple search online to find out what these averages are. So let's say you have a catering business, for example, and you're curious as to what percentage of customers don't pay. You can simply search what is the average bad debt expense for a catering business, or average bad debt percentage for a catering business, and you'll be able to find that out. But in this business, in this example, we're just doing we estimate about $1,500, so we're doing it by dollar amount rather than percentage. You can do either. So we say $1,500 a year. So at the end of each year, we're gonna make our estimate. We're gonna debit bad debt expense, and we're gonna credit allowance for doubtful accounts. Now remember that allowance for doubtful accounts holds a credit balance, and it is an asset account on the balance sheet. So here's the balance sheet. As you can see, we have our accounts receivable still sitting at 20,000, but we have this other account called the allowance for doubtful accounts that holds a negative balance, but it's an asset account, which makes our effective accounts receivable total 18,500. So you'll see it expressed in either format, but regardless of the format, it shows our effective accounts receivable balance. Okay. We could also have specific customers that we can use this estimation with. So here I have that same customer that hadn't paid us, and so we can use that fund that we set aside in the allowance for doubtful accounts. We can use that fund, that $1,500, to then draw that amount down based off of the customers that actually don't pay us. Because remember, the $1,500 is an estimate. Now, here we have an example where, yeah, a customer didn't pay us. So we originally set aside the 1,500. Now I have this customer that didn't pay me. They owed me 520. So I'm going to debit the allowance for doubtful accounts by 520, and I'm going to credit that customer's account receivable. What that's effectively doing is it's taking out that account receivable and drawing it down from the allowance for doubtful accounts balance. So what does that look like as with respect to the total account receivable? So before the write-off, we had the 20,000, and then we had an allowance for doubtful accounts with a negative balance of 1,500, giving us total value of 18,500. After I the direct write-off, after I wrote off that account, I reduced my account receivable by the 520, giving 19,480. And I reduced the account allowance for doubtful accounts by the 520, bringing me down to 980. Guess what? Those balances still equal 18,500. So the net realizable value of the accounts receivable doesn't change. And then just like before, if a customer comes back magically and decides to pay that bill, we do just like we did before. We reverse the entry. So we debit the account receivable, credit allowance for doubtful account by the 520. Then we debit cash and credit the account receivable 520. So there's benefits and drawbacks to both the direct write-off method and the allowance for doubtful accounts method. Uh, and there's a couple of differences you should be aware of. So with the direct write-off method, there's no adjusting entry required here at the end of each year or month. The write-off includes a debit to bad debt expense and credit to the customer's account receivable, and it's relatively simple. With the allowance method, we are estimating a certain percentage of customers won't pay us, so we debit bad debt expense at the end of the year, and we credit allowance for doubtful accounts. Uh, and that's really the primary difference between the two. So overall, pretty straightforward, but it's important to know the nuances between the differences between these two. Now, how do we estimate allowance for doubtful accounts? There's really two ways we could do this. One is the percent of sales method, which I personally like because I can take all of my credit sales that I've made, all the sales I've made on accounts receivable throughout the year, and I can multiply that amount by a percentage that I expect that I'm not going to be able to collect. Like, 1%, 2%, 3%, whatever, of my sales I made are going to be uncollectible. That's the percent of sales method. It's really easy. The other method is called the balance sheet method. And there's two ways to look at the balance sheet method. One is through the percentage of accounts receivable. Pretty easy. The other is the aging of accounts receivable. Earlier, I told you about my customer that went past due. So gave him 30 days, didn't pay, sent a notice. Another 30 days, didn't pay, sent a notice. Another 30 days, another 30 days. We call that an aging report. In your accounting system, your QuickBooks, there's a report called the aging report, aging of accounts receivable report. And it shows you how old the outstanding balance is. That's what it means by aging. Yeah. I'll show you an example of all this stuff. So first, let's take a look at that percent of sales method. Now, this one's really easy. We take the bad debt expense and we compute it by taking our total sales, I should say total credit sales, sales we made on accounts receivable. And we multiply that by our bad debt percentage. Now, the bad debt percentage itself is something that management determines, and it's usually based off of the past history or the industry average or something along those lines. Okay. And that'll give us our estimated bad debt expense. Very, very easy. Show you an example of this. So here we have an example where this piano store, I think it's a piano store, I'm just going to call it that, Music Land, has credit sales of 400,000 in 2027. Company estimates that 0.6% of all credit sales will be uncollectible. This is based off of historical uh, business. Okay. So for 2027, we're going to make an adjusting entry. So December 31, 2027, I go into my accounting system, I select that date, I take $400,000 in credit sales, I multiply that by 0.6%. That gives me $2,400 of bad debt expense. So I debit bad debt expense, I credit allowance for doubtful accounts. Very easy to do. This is probably the most simplest method, really. So that is the percent of sales method. Now let's talk about the first balance sheet method called the percent of receivables method. Percent of receivables method is also called the balance sheet method because we assume that a percent of the company's total receivables are going to be uncollectible. This percent's based off of historical trends. So the way that we calculate this is we take our total accounts receivable, we multiply that by the percentage that we expect not to be able to collect, and that'll give me my estimated uncollectible amount. Okay, once I have my estimated uncollectible amount, I can then compute the bad debt expense. I take the total estimated bad debt expense that we got from the first step, so accounts receivable times the bad debt percentage, minus the prior balance in the allowance for doubtful accounts to equal the current bad debt expense. That is the percent of receivables method. I'll walk through a quick example with you. Looking at our company, Music Land, the piano company, we have $50,000 sitting in accounts receivable. We have a $200 credit balance sitting in allowance for doubtful accounts from the prior year. We estimate 5% of our total accounts receivable will be uncollectible. So first thing we do is we take the 50,000 accounts receivable amount times the 5%. That gives me 2,500. So 2,500, my estimated bad debt expense. Then we subtract out the prior period. The prior period was $200. So that gives me 2,300. So at the end of 2027, I debit bad debt expense 2,300 and I credit allowance for doubtful accounts 2,300. It's just a matter of remembering the steps. Okay. So total accounts receivable times the percentage gives you the bad debt expense. Bad debt expense minus the prior balance in allowance for doubtful accounts equals the new bad debt expense or adjusted bad debt expense. So that's the percent of receivables method. Next, I'd like to talk about the aging of accounts receivable method. And this is information we get from our aging report in our accounting information system. This report classifies all of our accounts receivable based off of how far it's past due. That's why I call it an aging report. Each age group is multiplied by its estimated bad debt percentage. So we have individual bad debt percentages based off of how old the accounts receivable is. The estimated bad debt expense for each group are totaled up, and that will give us our total estimated bad debt expense for the year. So let me show you how it works. So here we have an aging report. On the left, we have listed out all of our individual customers and their total balances. Now we have the not due yet category. This means that they're current on those totals. You know, they don't owe them yet. So that total amount, we made a total credit sales 50,000. Not due yet, 37,000. The company estimates that 2% of all credit sales will be uncollectible. So not due yet, 2%, 37,000 times 2%, 740 bucks that we expect not to be able to collect from our current sales. Then we get into past due, 1 day to 30 days past due. We're currently sitting at $6,500 balance of all of our outstanding invoices out to our customers. We expect 5% of 1 to 30 days past due not to be a collectible. That's 6,500 times the 5% gives me 325. Then I got 31 to 60 days past due. Total of 3,700 bucks sitting in that category. I expect that 10% of my customers that are 31 to 60 days past due not to pay me. So 3,700 times the 10% is 370. 61 to 90 days past due. Okay, now we're getting out there, right? I got a $1,900 balance sitting out there. I don't think I sold more to that customer, let me tell you. 1,900 bucks, 25% of that's going to be uncollectible, 61 to 90 days past due. That's 475. Then 90 days plus. I got 900 bucks sitting out there. 40% of that's going to be uncollectible. That's 360. I add up the categories totals. I get a total of $2,270 of estimated bad debt expense. Okay. So that's how the aging of accounts receivable works. I'll tell you, if this was my business, those percentages would be higher, a lot higher, the older it gets. So past 90 days, I mean, 40%, come on. That's probably like 60% my business. Anything beyond that goes way up. All right. So now that I have my 2,270 after adding up all my total categories, I then need to subtract out my prior balance. I had a $200 balance already in my allowance for doubtful accounts. So my 2,270, I subtract out the $200 prior balance. That gets me down to 2,070. So I debit bad debt expense, 2,070. I credit allowance for doubtful accounts, 2,070. And that's the process. Pretty easy, pretty straightforward. It's time consuming. It's just a matter of following the steps. All right. Let's see here. So we had that prior balance. Now, anytime you got a prior balance, we typically subtract it out. If there's an unadjusted balance, meaning that we had made a sale somewhere in between and it's just kind of sitting out there, we can add that in. So we have a estimated bad debt expense 2,270. We can add in any unadjusted balance to give us a required adjusted balance of 2,770. So we debit bad debt expense 2,770 and credit allowance for doubtful accounts 2,770. All right. So when it comes to estimating your bad debt expense, we can either look at it from an income statement perspective or a balance sheet perspective. If you're looking at it from an income statement perspective, we're looking at our total sales. More specifically, we're looking at our credit sales, the sales we made on account. So we can take our sales times the rate that we came up with, the bad debt expense rate, to give us our total bad debt expense. The other estimation, there's the two balance sheet methods. One is the percentage of accounts receivable, so total accounts receivable times the rate to give us the allowance for doubtful accounts. Or we can use the AGV accounts receivable report. We take the individual balances, multiply them by the individual rates, then we add up the totals to get the allowance for doubtful accounts. So it's just a nice summary slide, nice flow diagram, decision tree. Yeah, but yeah, that just kind of shows you the differences between the three methods. So that's when a customer don't pay. Hopefully they pay, right? We want our customers to pay us, but if they don't pay us, we got to write off that bad debt expense by using one of those three methods. Now let me tell you the story about the other customer that dodged me for many, many months. I caught up with them. Okay, I caught up with them. And I took that customer's account receivable, I converted it into a note receivable. I forced them to sign a promissory note that they promised to pay. I attached an interest rate to their balance and then gave them a certain amount of time to pay me. And then they would pay me the principal plus the interest. That's a note receivable. Sometimes you have a customer that don't pay you. You catch up with them. You charge them with the interest. To do that, you create a note receivable. I'm going to show you how that works. So a note receivable. A note receivable is when a customer don't pay you. You're going to convert their account receivable to a note receivable. You're going to attach interest. You're going to tell them the exact day that they have to pay you with the total balance. And then they're going to sign it. That signature's on what we call a promissory note. It's a promise to pay. It has a specified amount of time, an interest rate, when they have to pay it, and it typically denotes who's paying it, who's being paid to, all that good stuff. It's all on there. You probably had to sign one of these when you took out a student loan or any other loan. There's typically a promissory note involved. So here we have this example in front of us. We got $1,000 is the promissory note. We're giving the customer 90 days to pay us. They're going to pay us the $1,000 at a 12% interest rate within 90 days. Okay. So we got to figure out how much interest do they owe us. There's a really simple interest formula that we apply. Now, this shows you graphically, you can count the number of days, sure. But it's not always as straightforward as it sounds because there's not 365 days in a year. There's only 360 banking days in a year. So days that banks open, 360 days, not 365. So we need to be able to compute the interest. So we have the information, $1,000 face value of the note. 90 days is the time, 12% interest rate. Now, yeah, you could figure out how many days is that, when is it, to figure out when is it due, when's the customer going to pay us. So July 10, we made the note, 11 to 31, that's 21 days. August is another 31 days. September, there's 30 days there. And then the difference is 8 days. That'll bring us up to 90. So that means the customer is going to pay us on October 8th. So that's how we calculate when the payment is due. 90 days from the day that it was made. It's just a matter of looking up at a calendar and counting the number of days. Simple. Now, how do we compute the interest? It's very easy. We use the interest rate formula. Interest rate formula works like this. We take the face value, in this case $1,000, times the interest rate, 12%. or 0.12 times time. We express time in a fraction of a year. We only have 360 banking days in a year. We call this the banker's rule. So we take the 90 days divided by 360 banking days in a year. So face value times the interest rate times time. So $1,000 times 0.12 times time, which is 90 over 360, which is 0.25. $1,000 times 0.12 times 0.25 equals 30, but for $30 interest. So $30 is what the customer owes us of interest in addition to the $1,000. I'm going to show you how we record all of these transactions. So the first transaction is how we execute the note. This is us, the customer signing the promissory note. We need to go into our system and record the transaction. So I'm going to debit note receivable for that specific customer. I'm going to credit the sale. Or if I'm converting the customer receivable, if I'm converting it, if I'm converting the account receivable into a note receivable, instead of sales, it would be account receivable. All right. So record my sale. Next thing I got to do is when the customer pays me, I'm sorry, when the customer pays me on, when was this? October something, I think, right? Customer pays us. Yeah, October 8th, right? Customer pays us October 8th. So on October 8th, I'm going to debit cash $1,030. I'm going to credit interest receivable $30. And I'm going to credit note receivable 1,000. That's when we receive the note receivable. Here we have another example where the customer did not pay us, so we converted their account receivable into a note receivable. So we worked a deal out with the customer, said, hey, give me cash up front. The rest of it we're going to apply to note receivable. Customer agreed to pay $232 in cash up front. The remaining $600 balance was converted to a note receivable. Customer owed us a total of $832. So we debit cash $232, debit cash $232, debit note receivable $600, and credit the customer's account receivable $832. Now, when the customer goes to pay us in 60 days, what would that be? This December 4th? On December 4th, customer pays us, we're going to debit cash, the 600 plus the interest rate of 15%. We're going to credit the interest receivable, and we're going to credit the note receivable for 600. That's when they pay us. Now, sometimes you got customers that won't even pay that. So I'm going to talk to you about what happens if a note is dishonored. I'll also talk about when the note is honored, meaning the customer is actually paying us. So we showed you that earlier example. The customer's 60 days, 15%, $600. So it's real simple. We debit cash 615, debit note receivable 600, credit the interest revenue 15. Easy peasy, right? Now, what happens if the customer didn't pay us? Oh my. You go through all the trouble, right? You take their account receivable, convert it to a note receivable, then they still don't pay you. So what do? You take that total amount and put it all back on their account receivable. So here's how it works. $600 note, 15%, 60 days. Total amount expected to be received, $615. Customer doesn't pay us. So we debit their customer account receivable 615. We credit the interest revenue 15, and we credit the note receivable 600. This changes it from a note receivable back into account receivable, but we're also adding in the interest. And then if they still don't pay you by the end of the year, that's when you debit bad debt expense 615 and credit the account receivable 615 if they still don't pay you. We need to make adjusting entries for interest, both interest expense and interest receivable. So let's say we made a note receivable in 1 year and then it carries over into the next when the customer actually pays us. According to the matching principle, I still need to record the interest earned in that first year. So here we have an example where a company made a note receivable on December 16 for $3,000. It's 60 days. That's 2 months. 12% interest. So first I need to figure out how much interest I'm going to receive. Face value 3,000 times interest rate 0.12 times time 60 over 360. That's going to give you 60. It's going to give you a total of $60. Now, I made the note 12/16. My year end is 12/31. That's 15 days for the end of the year. So I need to recognize the 15 days of interest revenue. So the way I do that is I'm going to debit interest receivable $15 and credit interest revenue 15. Why 15? Only 15 days in that first year. The rest of the time, the other 45 days occurred in year two. So in year two, when the customer is paying me, which is the 60 days later, February 14, I'm going to debit cash 3,060 because that's what they're paying us, the face value plus the interest. I'm going to credit interest receivable 15 from the prior year. I'm going to credit interest revenue 45 from the second year. And I'm going to credit notes receivable 3,000 face value. And that is how notes receivable works. Once in a great while, you might run into a situation where a customer pays you early on their note receivable. Great. Now, you might be wondering, why would a customer do that? Well, it's the same reason why we do it. The reason why I pay my loans early is because I don't want the bank collecting all that interest. And that's the same reason why customers might pay us early. They don't want us collecting all that interest. So I'm going to show you how that works. I'll also show you how well, maybe I won't. I think I'm going to show you how we dispose of our receivables. Oh, this is good. And I think we may have talked about this in class. I think we did. So once in a while, company might be hurting for cash. And we might have customers that went past due, so we recognize that as a bad debt. But we know they're never going to pay us. So we might sell their account receivable to a collection agency. This is how collection agencies actually work. They buy bad debt from companies and they go after those customers for that full amount, even though the business doesn't even own that account anymore. Okay, that's the business of collection agency. So here we have an example of the company selling their receivables. So we debit cash, whatever the amount that we're receiving for the sale of that receivable. We debit factoring fee expense, which is a reduction on the amount that we would have received otherwise. And we credit accounts receivable for the amount that we sold. So we sold $20,000 in receivables. We received $19,200 for it. The difference is the factoring fee. Now, in reality, that factoring fee is going to be a lot higher. Okay, your textbook is only saying 4%. That's ridiculous. Most of the time, this is like 60%, not 4. All right, in practice, that fee's a lot higher. Okay. Now we also have what we call pledging receivables. Sometimes a bank might require collateral. Bank will require collateral. Okay. When that happens, we can use our receivables as collateral. So this is kind of like a way of securing a loan by pledging your account receivable. You're backing up the loan with your accounts receivable. Call that pledging receivables. In this case, we're just debiting cash and crediting the notes payable. If we don't repay that loan, the bank can take the receivables.
Coming from.
Yep.
Okay.
Go for it. You good? All right. Okay. Now, y'all know we love our ratios, so I need to give you one. This one's called the account receivable turnover ratio. And this one's great because it tells me how often we're collecting our accounts receivable. Yeah, that's basically what it tells me. Uh, to calculate this, it's very easy. We take our total sales, we divide that by average accounts receivable. Now remember, anytime you hear the word average in accounting, it's the beginning balance plus the ending balance. And then we divide that amount by 2, gives you the average. Okay? That's accounts receivable turnover. All right. So great news. We made it to the end of our discussion this evening on our receivables, accounting for receivables. Now, just to kind of remind you what's due for uh, this, I don't even know what I'm looking at this point. Look, for this week, we have your Chapter 9 quiz. I also recommend that you work through your exercises just to help reinforce what it is that we're learning this week. And this is all about receivables. And that'll get you through the week. Are there any questions, comments, concerns, anything at all that I can help to address?
Hey, Professor.
Kira,
I'm not sure if it says Zoom user.
it's what?
Is it showing Zoom user on my side?
It's showing your name.
Okay, good. No, because I came into class a little bit late, so I didn't know if you seen me.
I got you. I appreciate you saying that.
Okay. Okay.
Awesome. Great, great. Let's see. Let me just make sure I got everyone else too. Yeah, I got you, Kira. Uh, who else did I miss that came in later? I see Omar. I see you. Uh, Kaylee's here. I see you. Is Sasha here? I didn't see Sasha. Mario. Oh, Mario, huh? Levanta. Didn't see her. I didn't see Cora. Um, Steven. Steven here? No? Okay. Fair enough. All right. Great. So, yeah, just as a reminder, you get your Chapter 9 quiz. And I look forward to seeing you in person. I look forward to seeing you in person next week on Tuesday.
Okay. See you later.
Thank you all so much. I appreciate you all.
Thank
All
you,
right,
Griffin.
bye.
Have a good one.
Bye bye,
Take care.
Thank
Professor.
you. See you.
Take care, y'all. Bye bye.